Hello, investors. Welcome to one more monthly interaction with Canara Robeco. Let us start with the global piece. On the global front, it remains more of the same thing. The complexity continues on both the fronts, geopolitical front, as well as the tariff-related issues and its impact on growth. Let us start with the geopolitics first. There was an expectation that post Trump Putin interaction or last about a month, 1 month and half back, there will be some resolution, but it doesn't seem to be in sight. So that issue continues to kind of get protracted. Whereas there seems to be a renewed effort and hope that, as far as Israel Gaza is concerned, it is about to get resolved. Let us see how it plays out. As of now, but the both these issues remain as they were in terms of complexity and its impact on the various aspects of geopolitics. Coming to the tariff front, which has clearly created uncertainty and growth moderation over last few quarters, it continues to be as it is. As you would recall that initially there was an expectation that tariff related issues will subside probably faster, but they seem to be taking much longer. And the initial success of US pushing back in terms of tariff and this succeeding seems to have given renewed confidence to the US administration to continue on the same path. And that's where what you are observing now is there is a clear consistency in terms of direction, whereby it doesn't look like both, whether it is the tariff related policies or whether it is immigration related policies, there is any back off that you are actually seeing from the US government. In fact, on top of it, the latest issues related to visa cost addition, as well as basically tariffs on pharma innovators, are clear indication that the administration is convinced that they have to continue to travel the path whereby they eventually reduce the fiscal deficit, they reduce the trade deficit, and they actually increase the local manufacturing. I think that's the path they are traversing, and in that context, the India-US tariff deal has been getting delayed. While there are a lot of hopes that it will get resolved on a near-term basis, we're also hoping that it will get resolved in a quarter or two. But the contours, given the way US administration's policies are, look like they are not going to be very supportive for India either. That's where we are. Complex geopolitics, complex tariff-related issues. Tariff-related issues continue to actually have an impact on the global trade. Growth moderation is here to stay for a few quarters, at least till the time these issues are actually flown through the system, and its impact is visible everywhere, including the US European growth, as well as the US inflation, which has been sticky at a higher level. That's the environment in which we are operating in. Clearly, this is an environment, along with that, the starting higher valuations in India have clearly ensured that basically India flows have not been very supportive. So even when you look at the flows from global front perspective, the flows has been predominantly actually net positive for China among the emerging markets, and a little bit Taiwan and Korea, but rest of the emerging markets haven't seen lately any significant inflows. So that's the global piece to start with. Coming to the local piece, the domestic macro remains impeccable, as we have been discussing. I think whether it is balance sheets of corporates, real estate, government, top 20-30 crore households, that is not a challenge. The challenge has been growth, and growth still remains a challenge. And I think that challenge is at the margin getting accentuated, while there are certain things that government is doing, and we'll discuss those. But that's where the challenge is. Just look at India's inflation. India's inflation has been undershooting persistently. Now RBI is projecting roughly 3.5% of inflation for financial year 26, which probably is as almost virtually as low as the US inflation. And that is what is actually leading to growth of corporate India in terms of top line being low. Just to put it in perspective, the nominal GDP growth rate of India has actually been undershooting as compared to the historical levels over last 6 quarters, and that is flowing into the growth parameters, and that needs to be corrected while inflation will gradually come back. I think some of the corrective modes that are being in place currently is the way government has actually decided to push the consumption expenditure through social welfare schemes at state, through the GST tax cuts, which will add 1.5-2 lakh crore rupees, through the corporate tax rate cuts that they did through the budget personal tax cuts that they gave in the last budget, which was roughly 1 lakh crore rupees. When you add all these numbers together, they add up to about 3.5 to 5 lakh crore rupees, which is 1.5 to 2% of boost on the revenue expenditure consumption side to the economy. So that's the brighter part of the basically the economy. No challenge on balance sheet side. Growth is a challenge. Lower inflation is a challenge, and which is driving down the growth further. In that context, government is actually using all its possible levers to actually push up the growth, and that's where we are. How are we looking at the corporate earnings growth? As we have been alluding for last 3 months, cyclically, our sense is the earnings growth is already recovering. Financial year 25 was 5% earnings growth. First quarter was 7-8% earnings growth. While the earnings growth is not recovering significantly, the earnings downgrades have stopped over last 3 quarters, and earnings recovery has gradually started taking place. As we have been alluding, that a combination of government expenditure, combination of interest rate cuts by RBI, combination of surplus liquidity in the domestic market, third in a row good monsoon, and just a cyclical recovery in a lot of basically demand in a lot of sectors, we see basically that the earnings growth likely to move back to low double digit as you go into second half of financial year 26 and financial year 27. And that's where, while financial year 25 was really a bad year in terms of earnings growth at mid single digit, it is likely to move to low to mid double digit as you go into financial year 27 and 28. So that's the earnings picture. Cyclically bottom has been formed. We are experiencing already a gradual recovery. It is just that the recovery is very, very moderate or modest. In terms of sectors, largely the domestic sectors, cyclicals, continues to do well. Part of financials, industrials, telecom, pharma, domestic pharma, particularly hospitals, hotels, aviation, IT, FMCG, pure banks still in terms of earnings continue to actually struggle. But financials will have a recovery of earnings growth as you go through this year. So that's where the earnings picture is. That's how the sectoral picture looks like. In terms of valuation, the market is trading at roughly 20 times 1 year forward, 1.5 year forward earnings growth, which is in a fair zone. As you go into mid cap, small cap, we have maintained that the earnings need to catch up there because the valuation still remain 20-25% expensive as compared to their own historical level. So either the earnings have to significantly surprise over next 2 years in that part of the market, or the rollovers would be relatively modest in that part of the market in term given the starting valuation. So that's where we are. Cyclical earnings recovery, constructive from a medium term perspective, but near term still the view remains that till the time the top down worries in terms of tariffs and undershooting of inflation, as well as the bottom up basically worry of earnings growth actually firmly settling in low double digit. Till the time that happens, still it looks like a consolidation zone and a range bound market for us in India. So that's largely from our side for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.